So a question that a lot of clients have at the very start of the mortgage journey is what other costs they should consider, when they're considering their monthly budget, how much they can afford to pay to a mortgage. There is a danger when you're looking at the maximum amount you can borrow that the only thing that you consider is how much is this mortgage going to cost me. But there's a few other things that you need to factor in, mainly insurances. So I'm going to cover off some of the key insurances that you really should consider when you're putting your budget together. Now, there's actually only one mandatory insurance, and that is buildings insurance. Buildings being the fabric of the property, so a policy that protects any kind of damage or loss to your walls, your ceilings, your roofs, that kind of thing. And the main reason for that is because the lender's security is based on your house still existing. So you'll find in your mortgage offer that there'll be a clause that the lender puts in place where you have to have adequate buildings insurance, and your solicitor will probably consider that as well. Alongside that, you can also have contents insurance, which obviously is for sort of loss, theft or damage to your stuff. Aside from that, it's mainly health related insurances and income related insurances, because at the end of the day you want to make sure that yes, you've got the dream house, but you want to know that whatever happens in life, that you're able to keep that house. So you can consider life insurance, critical illness insurance and income protection insurance. So one by one, life insurance will pay off the mortgage if you died, quite simply. There's variations on the theme, but the basic one that you would need for the mortgage is what they would call a decreasing term mortgage insurance, where the amount you're insured for starts at the same level as the mortgage, and that then steadily decreases during the term in line with the mortgage balance decreasing. The idea being that if you or whoever you've taken the mortgage out with died during the term, you would have a payout that would be enough to clear off the existing mortgage balance, and the house is left mortgage free for whoever remains. Your second policy is called critical illness insurance. Now, critical illness insurance is designed to pay out in situations where you're diagnosed with an illness which is potentially life-threatening. So things like a cancer or a stroke or heart disease, or even permanent disability where maybe a car crash has resulted in kind of life-altering conditions. And it's not quite so cut and dried as the life cover as to why you would take that. I mean, essentially what it does is it will pay out a lump sum, but that doesn't necessarily have to be a lump sum that pays off the mortgage. It could just be a lump sum that allows you to maintain the payments for 3, 4 or 5 years while you're going through treatment. Or maybe you need to make some alterations to the structure of the house, widen doorways or install a downstairs bathroom, something along those lines that makes life a little bit easier, a little bit more comfortable for you. And if you want, you can have enough to cover off the mortgage, but it's probably more important to maintain lifestyle and affordability with this one. Your third insurance is income protection, and this one's slightly different. This is designed to enhance any sick pay benefit that you would get from your employer. So for example, if you have, say you have an NHS style sick pay where you would get full pay for 6 months and then a half pay for 6 months after that, an income protection policy would sit alongside that employer sick pay. So once your employer has stopped paying you any kind of sick pay benefit, that's when your income protection policy would start to come into play. So in that scenario, you wouldn't get any benefit from your insurance plan whatsoever for the first 12 months. Once you're into month 13, that's when your claim starts to pay out. And on a kind of good gold standard level income protection policy, that insurance will pay out every month, either until you return to work or until you hit retirement age. It'll increase in line with the retail price index, and it also gives you the option of a partial payment if you went back to work on a kind of reduced income or you decided to go back on part-time hours. So really kind of valuable level of cover. And you can take it to the opposite end of the spectrum as well. So if you maybe don't get any sick pay from your work or you're self-employed, then you can have a plan which would start to pay out from 1 month or 3 months, for example. Now, there's a lot of flexibility with these plans. You can have very, very cheap plans that give you a basic level of cover. You can have gold standard plans that cover every eventuality. And your mortgage broker will go through these ideally at the initial point of contact, so that you know that your mortgage might be costing X amount, but you've also got a budget over and above that to pay for the policies that are going to protect that mortgage and protect that property. Any questions on any of these, just pop them in the comments. We'll try and cover off anything that you ask and just give you the knowledge that you need to be fully armed when you go in and sit in front of your mortgage professional. Please do send comments, and yeah, good luck with the process.